Income statement is going to be a financial report that shows your profit and loss for a particular period of time. This will be your sales less your expenses to get down to your net income or loss. Now this can be for a 1 month period. Typically you're going to see quarterly or annual. I'm going to give you a couple of reasons why an income statement is important. One, if you have investors, they're going to absolutely want to look at your profitability. They're also going to look at your expenses and revenue. They want to see what that return on investment is going to look like on a regular basis. Banks, if you have bank debt or a bank loan, they're going to want to look at your income statement to ensure profitability is still there. And if you have bank covenants, they're going to do those ratios against your balance sheet and your income statement to validate you're within the terms of your debt agreement. Government bodies and taxing agencies, via your tax return, they're going to want to look at your income statement to see what sort of taxes you owe based on the results you had for that period of time. Now let's dive a little deeper into the income statement and look at the different parts. And depending on what industry you're in, you could see different parts. Full disclosure, I've never worked in a industry where a product has been made, so cost of goods sold is fairly foreign to me, but I'll cover it surface level. So top level, you got revenue. This is going to be your sales. This is what you have sold in the marketplace. This is going to be if you're like Dell, a computer manufacturer. This is your PCs and laptops you've sold. If you're a builder, these are the homes you've sold. If you're an accounting firm, these are the tax engagements that you've collected on. If you're a grocery store, the groceries that you've sold, this is going to be your top level sales, aka your revenue. Next piece, cost of goods sold. That's going to be made up of 3 different categories. You got raw materials, direct labor, and direct overhead. Raw materials, I'm going to stick with the Dell example. It's going to be like chips, plastic, metals, memory, anything that goes into making a laptop or PC. These direct labor, these are going to be the employees you've hired to make these laptops and PCs. And you got direct overhead. This is going to be like the facilities they're in making the laptops and PCs. So you throw all those pieces together, the raw materials, the direct overhead, and the direct labor to get your cost of goods sold. So from there, you take your sales. So in your Dell example, all the PCs and laptops you sold, you got your cost of goods sold, your raw materials, your direct labor, your direct overhead to get to your gross margin or gross profit or net revenue, whatever you want to call it. To me, those 3 are interchangeable. Revenue. So from there, we're going to keep going down the expense line. Operating expenses. This is going to be your SG&A. This is your sales, your general and administrative costs. This will be what you pay your salespeople to sell those products. This is going to be your rent, your insurance, your advertising, costs related to selling or promoting the business. And then you're going to have your administrative costs. This will be your accounting, your HR departments, any costs associated like that for back office. These are going to be your operating expenses. Basically, you can't tie them directly to producing the product. That's why they're not in cost of goods sold. So let's just go back up. We got our revenue, less our cost of goods sold to get to our gross margin. From our gross margin, aka net revenue, we're going to take our operating expenses, deduct those to get down to EBITDA. What is EBITDA? I'm sure you've heard that term that gets thrown around a lot. Depending on what industry you're in, it could be very important or it could just be meaningless. But EBITDA is essentially your operating profit. I know it's not your net income. We'll go further down and explain that. But your operating earnings, basically what you sold and what it costs to sell those items, whether producing it, selling that, or just keeping the business running. Once we're at that EBITDA level, we're going to dive into what I call below the line expenses. These are going to be expenses related to financing, tax, non-current assets, non-current intangible assets. These are going to be items that are not directly tied to the business operations, but are a cost of the overall operation. So let's do interest first, the I in EBITDA. Interest is going to be related to any financing that you've obtained, whether that's a bank loan, you issued bonds, the interest that you've paid on that bank debt or bonds. Next is taxes. This is going to go back to the government agencies. This is what you've paid to the federal government, the state governments. These are the taxes you've paid related to your operations. Next level down, depreciation. This is where I'm going to highly suggest checking out my balance sheet video so you can see what a non-current asset is. So 2 non-currents we're going to cover. One related to depreciation. These are going to be items that have a longer useful life. So if you're a builder, you're going to have trucks, you're going to have earth movers. These are items that are not going to go directly into your operating expenses. They actually get put onto your balance sheet as a non-current asset and are depreciated over their useful life. Depreciated is a fancy word for expensing. So instead of expensing it all in 1 year, you're going to expense it over its useful life. Let's say a truck's good for 5 years. So if you bought a $50,000 truck and it's a 5-year useful life, you're going to depreciate it $10,000 per year. Intangible assets. These are also going to be non-current assets that are on the balance sheet. Intangible meaning it doesn't really have a physical quality to it like a truck does. So like a book of business you've purchased from another agency. So if you're an insurance agency, you buy another book of business from that insurance agency, you're going to put it on your balance sheet as an intangible, amortize it over its useful life. So you paid $100,000 for a book of business, 10-year useful life, you're going to have $10,000 of amortization. So once you get through deducting your interest, your taxes, your depreciation, your amortization, basically your financing costs, your costs related to paying taxes to governments, and your non-current assets expensing, aka depreciation and amortization, you get down to net income or net loss if that's the case. But net income is going to be what's left over after your business is done what it's done. Basically, your sales less all your expenses gets down to your net income, what's left over. So let's just give 2 quick examples of an income statement and how you can analyze that to get a decent idea of what's going on with this operations. So let's go with the industry that carries a 20% EBITDA margins as a industry average. So EBITDA margin is going to be your EBITDA divided by your revenue. This is going to be your operations profitability. So let's say 20% is kind of like the mean, the average. So company A does 100 million in revenue, has a 25% EBITDA margin. That could be a good thing. Maybe they had just a crazy year. Profitability was off the marks. Just revenue came in higher than they expected, and they just had higher profitability. It also could be a bad sign because maybe that company isn't reinvesting for the future, and they're keeping more cash flow in the entity and not reinvesting it back into the company. So you can take it both ways. Let's go company B. They got 20 million of revenue, carrying a 10% EBITDA margin. That, on a surface level, might be a bad sign, but you got to look at where the entity is in their business cycle. Or business life. If they just started, that might be okay. If they made a huge investment, that also might be okay. If their expenses are way out of control and they're not managing well, that's not a good sign. So that's just a real quick way you can look at a income statement, just get a good idea. Like, okay, do they have a stellar year, or are they not reinvesting in their company? Is this a brand new entity that's getting it off the ground, or are they just not managing expenses very well? So that is just 2 quick ways you can identify an income statement and get an idea of what is going on.